Welcome back to Talk Tickers. Today, we're jumping into the latest earnings from Dynatrace, and wow, this one's a head-scratcher. On paper, it looked like a picture-perfect quarter. So why on earth did the stock take a hit? Let's get into it. All right, so the whole story here is really a tale of two completely different realities, right? You've got the company's fantastic performance on one side, and then the market's pretty brutal reaction on the other. So first things first, let's just focus on the performance because honestly, the numbers themselves were really impressive.
So if you just glance at the headline numbers, everything looks like it's going exactly right. I mean, Dynatrace absolutely delivered on the bottom line, coming in with a solid 3-cent earnings beat. No complaints there.
And it's not just the bottom line. The top line was just as strong. They beat revenue expectations by more than $6.5 million. Again, really impressive stuff. And look, this wasn't some kind of fluke, right? This was driven by a really healthy 18% jump in subscription revenue. And that's the absolute lifeblood of their business. So by all accounts, this was a super clean, super strong quarter. Period.
Okay, so with numbers this good, you have to ask, what's the story management is telling? What's the core strategy here? And really, it all boils down to just one word: consolidation.
Yeah, the CEO, Rick McConnell, he was crystal clear about this on the earnings call. He basically said their success is coming from big companies getting totally fed up with trying to manage dozens of different fragmented software tools. They're just tired of it. And instead, they're looking to move to one single end-to-end platform, and that's where Dynatrace comes in. And you can actually see this strategy playing out in real time. I mean, they're not just selling some vague idea here. They are actively embedding themselves right into the most critical workflows through some huge partnerships. We're talking giants like ServiceNow, Atlassian, and AWS. So the big question is, does this whole consolidation strategy actually translate into real growth? Well, let's pop the hood and look at the key metrics that tell us if this thing is really working. The most important indicator to watch here is their platform subscription model, what they call DPS. You can think of it as the engine driving all these big consolidation deals. And get this, it now makes up a massive 70% of their recurring revenue. That is a huge milestone, and it's proof that customers are really buying into this all-in-one platform vision. And that DPS model, it's landing them the whales. We're talking about deals worth over $1 million a year, and those surged an incredible 53%. You've got some of the largest companies in the world placing some seriously big bets on this platform. The growth isn't just isolated to one little area either. Their total recurring revenue is creeping up on $1.9 billion. And one of their specific products, log management, is just on fire. It's growing over 100% and acting like this powerful gateway to get customers onto the bigger platform. And on top of all that, they're so confident that they're using their cash to buy back $50 million in stock. That's a pretty strong signal to investors.
Okay, so all of this brings us to the forward-looking view. And it gives us some context for that really puzzling stock performance we talked about right at the beginning. And this chart really captures the investor frustration perfectly. I mean, despite everything we just went over, all those great numbers, the stock is down over 17%. And this is in a year where the broader market and other software companies are just soaring. So you have to ask, what is the market seeing that the numbers just aren't showing? And yet, here's the crazy part. Management is signaling the complete opposite of what that stock chart is telling us. They raised their full-year guidance on everything: earnings, revenue, cash flow, you name it. This is basically management looking at the market and saying, you've got it all wrong. So if this stock is going to turn around, what needs to happen? Well, investors are going to be watching for a few key things. First, they absolutely have to hit their next quarter's guidance. That's just non-negotiable. Second, those big partnerships we talked about, they need to start showing up as tangible results, on the revenue line. And third, they've got to prove that this momentum with the huge million-dollar deals and the platform adoption isn't just a blip, that it can keep accelerating.
All right, so let's put all the pieces together. How do we synthesize all of this data into an actual, actionable call for investors?
The bull case here is pretty straightforward, right? The company is executing flawlessly and they're riding this massive tailwind of tool consolidation. The bear case, well, it's not really about the company's performance at all. It's about this persistent negative feeling, this valuation concern that the company just can't seem to shake no matter how great their numbers are. So our call on this is outperform. We just see a massive disconnect between the company's incredible execution and where the stock is trading. It feels like the market is stuck pricing in old stories and it's completely ignoring the powerful consolidation trend that the numbers are screaming is happening right now. And at some point the fundamentals just have to win out. And as always, this is not financial advice.